Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Tuesday, August 24th, 2021. And our top story today, the state of financial markets and investors await taper clues from this year's Jackson Hole Symposium. Well, joining me now to discuss this and a lot more, Larry Shover is the Chief Investment Officer for D. Alexander Capital. Larry, it's so great to see you. Thanks so much for joining us this morning.
Yeah, great to be here, Jeff. Thank you so much.
Yeah, and it is great to finally have you on the program to kind of weigh in on the markets. We'll talk a little bit more about the Jackson Hole Symposium. Let's start with your analysis of where we stand today with financial markets and the economic data that you and others are seeing.
Yeah, well, with the economic data, the second tier consumer related data has been dour at best. We talk about Empire Manufacturing, University of Michigan, Philadelphia Fed's index. All of them have showed an abrupt about face with regards to the consumer being fearful. The sentiment is down. And, naysayers will say, well, that's just second tier data. But I would counter and say the consumer at this point is just about everything that turns our economy. So the consumer goes, so does the economy.
Yeah, really, really important to note. And we heard, I guess, when things were about to reopen, that there was a lot of pent-up consumer demand. People were saving money. They weren't spending. They were anticipating this thing being over. Now the resurgence of the Delta variant, is that kind of the old way of thinking? Now the new way of thinking is, hey, we're not through this yet. We may never really be back to the old normal. We're going to be in a new normal. Let's hold off spending.
Yeah, I think it's a little bit of both. You brought up a point that a lot of people don't bring up, and that is like, okay, there was a lot of pent up demand. A lot of people have said that, but even without the Delta variant, at some point you'd think that has run its course. I mean, we all had things we wanted to do, couldn't look forward to doing when restrictions were lifted. The Delta variant clearly has thrown a curveball into that, and I think the market, the consumer, is just waiting, not just for the Delta variant, but just for these rolling variants. Is there anything else that's going to come behind it, and is this the new normal?
And we're going to talk about the Fed and the Jackson Hole Symposium in the second segment, but what's your reaction to some of the words that we're hearing from the Federal Reserve as it relates to interest rates? Interest rate policy serves a very important component to how asset managers like yourself really view the markets on a go-forward basis. What's your take on what we're hearing from them?
I think what we're hearing from them is first of all, it's been well telegraphed by Powell that, the tapering announcement is going to be made sometime over the next 3 meetings, whether it's September, November, or December. I think what's behind that or underneath that is really the Federal Reserve is probably looking for flexibility in dealing with either has inflation run too hot or run its course? I mean, should they taper quickly or slowly, given the fact that we might have more, I shouldn't say we're going to have more. We might have more Delta variants or other rolling variants to deal with. So I think it's the flexibility that the Fed is looking for more than anything else.
And when it comes to, we have a lot of regular, real people who are trying to save for their retirement, maybe trying to buy a home. We also have institutional investors who are looking to invest for their pension funds. I mean, what do you tell them as the chief investment officer, without giving any investment advice, because we're not here to do that, but What do you tell them in terms of the long term and how to think about this in the scheme of the long-term investor, the long-term horizon?
Yeah, I love that question because I do this myself over and over again. I've been in the business for 35 years, and a lot has happened in 35 years. And I even looked before I even started in the business and try to remember what it felt like before that event, and like how many times that you wanted to just bail out or not invest, or you're too scared because like the unsurety. But the market's always full of it. And go back to the Bretton Woods Act all the way till, through 1987, 2011, the Great Recession, everything. It just seems like the market has a way of working itself out, and to just not get caught up in the headlines as dour as they might be.
Yeah, I feel like we can often talk ourselves, or some of the commentary you hear, whether it's in the press or from the Fed or whomever, we can talk ourselves into a downturn. We can talk ourselves into a recession. Larry, I got a question for you out of left field or right field, depending on what position you play. Let's talk a little bit about cryptocurrency real quick, because this is something that has really been, I think we've seen a lot of volatility, a lot of people interested. And I see a lot of retail investors, or hear a lot of retail investors getting involved with trading, and that's a good thing. But I also hear about people, at the water cooler, the virtual water cooler, talking about investing in things like Bitcoin and Ethereum. How does that kind of fit into a portfolio for long-term investing?
I'm not so certain that it does. I mean, at this point, believe it or not, even though there's so much money tied up in it right now, it's still in its infancy. And what's going to happen to cryptocurrency, let's say 3, 5, 10 years from now, is going to be much different than what it is today. And so I think, I know Bitcoin had just made an extreme reversal off of 30,000 up to 50,000. Now, all of a sudden, everybody's excited again, but nobody was excited when it was down at 30,000. So I think I would just question one's motives and why you want to invest in it for the long term. And perhaps there are good reasons, but I haven't seen them yet.
Really good point. Larry, I need to take a very quick break. When we come back, we'll talk to Larry about the Jackson Hole Symposium and what's it mean for investors. You're going to want to stay tuned right here on BRN AM.
You need a financial plan that fits the way you want to live in retirement. A plan that can help grow and protect your money, now or in the future. With an annuity in your plan to help cover essential expenses, you'll have the freedom to live the retirement you want. This is what an annuity can do. Find the right financial professional to show you how. Learn more at protectedincome.org.
Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking to Larry Shover. He's Chief Investment Officer for D. Alexander Capital. Larry, thanks so much for staying with us this morning.
Thank you. Great to be here.
Yeah, really great. I love when we get the chance to talk to a professional like yourself who is knee deep into investing and can share some of that knowledge with our audience. Let's talk about this Jackson Hole Symposium. We're hearing a lot about it. People are making the media and others are making a big deal about it. First, what is this symposium all about?
Yeah, great question, because the symposium is not meant to be a policy meeting. It's not like the meetings that they have, and they're having one in September, November, December. This is an event that is always meant to lay down the foundation of the bigger picture of the Federal Reserve. And make no mistake about it, there have been past symposiums put on by the Kansas City Fed that have ended up being policy meetings, but that's not the intention. And I think this one's a big deal just because, well, one, media is making it a big deal, but two, we've had this Delta variant that has it has disrupted our economic momentum, as it were. So a lot of people are looking for answers. And it's even disrupted to the point where it used to be in Jackson Hole, Wyoming. I guess it's going to be virtual this year. No one's flying anywhere. I guess that's just a sign of the times. But a lot of investors kind of will take away from Chairman Powell around his thoughts around interest rates. I think other other Fed governors have weighed in. So do you make anything of what we're going to get out of this, or is it just, hey, you got to see how they actually act instead of what they say? Yeah, well, I think it's going to be a letdown. and usually these things are, because the more they're built up. But the fact remains that, as I said in the first segment, Chairman Powell did prime markets already for tapering. And whether it's September, November, December, personally, I think that he's going to wait until the November or December meeting, because with the Delta variant in front of us, what's the incentive right now? I think the wild card, though, is that if he does choose on tapering in the September meeting, setting up the market for interest rate hikes, you have to think, well, are they doing this because has inflation really gotten out of control, or is it fleeting, or the word they use is transitory? So that's the only thing beneath the surface that I would look for. But other than that, I don't see a big incentive for making the announcement before the fourth quarter. And when we do get an interest rate hike, where does it's a domino effect. So I guess you would see indications of this in the market, although I think you indicated that the market's already pricing this in. Yes. It's anticipating this. But where else would we see the implications of this? Will we, for example, see implications in some way to mortgage rates or borrowing rates for individuals who are looking to buy a house, build a house, whatever? Yeah. So even though I think it's basically priced into the market, it might not be fully priced into the shorter end of the market. So the 2-year, especially the 5-year part of the curve. So maybe shorter term borrowing. When it comes to mortgages or longer term rates, like a 10-year and a 30-year, that's directly correlated to the growth and inflation outlook of the world and the United States. So the change that we might see, if there's any kind of disruption to what we think he's going to say, it would be the shorter end of the curve, or the 2-year and the 5-year sectors. And we haven't really spent a lot of time on the bond market, but obviously interest rates, I think, have an inverse relationship with bond yields. What does this all mean
potentially, again, underscoring potentially, because we don't, past performance is not prologue.
Right.
But what is, right? I mean, we got to put that disclaimer in there somewhere. We're not actually going to put it there, but I'm going to say it. But what does this mean for, bond markets, which are often overlooked? We tend to always think about equity markets and stocks, but bonds play an important role, especially for people who are retirees.
Yeah, oh, absolutely. And it's the bellwether for the stock market. So if you recall, in the first quarter, we had the 10-year yield up around 1.77, so far distance from where it is today. And the stock market didn't bat an eye. In fact, the stock market enjoyed that because it was saying, hey, the macro outlook is sturdy. Interest rates are going higher. That's a good thing. I mean, not going higher, like enormously higher, but a little bit higher. There does come a breaking point, though. I mean, if interest rates would shoot up to like 3%, then yeah, that would be worrisome for the stock market, especially the technology sector, which really does rely on interest rates. So it's more of an equilibrium thing. But from my view, I look at the equity market through the lens of both the FX and the bond market.
Larry, when it comes to pensions rely heavily on interest rates to determine their liability and their funding requirements. And so I would imagine that pension investors, large money managers, really looking at this and saying, okay, what can we expect? But what does a potential interest rate change mean to these pension investors? Or, by the way, annuitants, people who are looking to annuitize a portion of their retirement balance, whether it's in their 401k, in IRA, or maybe they're going to take it out of their pension plan.
Yeah, well, it's a good thing because they rely on yield just like the retiree relies on yield, whether it be a CD or whatever. And so interest rates on the short end of the curve going higher is good for them. That's what they need. On the flip side, though, with interest rates having been so low for so long, it has forced some of the larger investors out the curve to take bigger risks for smaller return. And that's something that's problematic along a lot of the pension industry. So could that affect the individual investor? Absolutely. But it's just the way it goes because like rates are so low, it has forced people to take risks they otherwise would never even think about taking.
Yeah, I think you're alluding to maybe allocating a portion of assets to things like alternative investments where they potentially could see higher returns, but with that, you've got a lot more risk, higher fees, and challenges with liquidity.
Correct. It goes on to like real estate, oil, just things that maybe aren't necessarily risky in themselves, but they're outside the scope or perhaps the soft mandate that a lot of these pension managers have. And corporate high credit, they have to do something to get yield for their investors, so they're forced to do things they wouldn't normally do.
And are you seeing, to that point, and again, this is another question out of left or right field or center field, depending again what position you play, but are you seeing a lot more due diligence in terms of some of these other products from your clients, like for example, due diligence on things like environmental, social, and governance to really understand what's at the heart of these investments, or private equity, or you mentioned oil and futures. I mean, I would think that this requires a lot of understanding and then education of clients to make sure that they understand if they're fiduciaries, what they're getting themselves in, and by the way, they're beneficiaries into.
Yeah, there seems to be a much higher level of due diligence, but the fact remains that even the in-between, the go-between person that's supposed to be the fiduciary in the whole thing may not understand the risks themselves, even though it's put out into a prospectus or some kind of document. The probability of something happens, to me, that word doesn't even exist or shouldn't exist in a financial conversation, because it's not the probability or odds of something occurring. It's like, well, what happens if it does occur? Like, what's the end result to me, the investor? And so that's why I think an additional level of due diligence is always in order, because I'm not throwing rocks at a financial advisor at all. I'm just saying with most people, like none of us really understand the inherent risks of some of the things that are floating around us. And we have to be more concerned with how's that going to impact me if that 1 in 1,000 thing happens.
Yeah, really good point. And especially in light of what happened in 2008, some of
Yes.
the recessions, 1929, et cetera. Really important to get your arms around what those things mean. Larry, we're going to have to leave it there. I wish we could go on for hours, quite frankly. It's always great to pick your brain. Thanks so much for joining us on the program, and we look forward to having you back on again very soon.
Thank you so much for the opportunity.
Thanks, Larry. Great to see you. Thanks for sharing your perspective. That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement, markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.